So we are reading for corporate reporting. I think you know the value of this subject. Not that much easy subject, right? So the core subject of the degree, we have given more weightage and more credit to this subject. That's why we are here as listening lecturer for give practical experience about more technical accounting treatments about standards, right? Here we are. I think you have completed financial reporting. We are supposed to do here corporate reporting, including standards, not only simple standard, complicated standards and consolidation, right? We have financial reporting aspect as well. I hope you know the gravity and seriousness of this subject. The high fail rate and most of the once I am marking papers, if you are having like 50 students, I'm having average 90 papers per batch. It means many people are repeating this subject because it is difficult. Then pay your attention, think that as a risk and take preventive actions to pass this subject. Not only that, we are not learning just for this subject, right? We are learning this for earn money. Earn money means once you are doing this subject, please remember that whatever the content we are learning here, that will be directly impact your profession near future. Maybe you are reading for SFRS 13, parallel. You are doing that in your job within another 1 year time. Consolidation, we are learning for earn money, not for the exam, right? If you can be a person, doing a consolidation for a group company. You can be part of that division. That's why we are learning this subject. Your fullest support should be there. Especially once we are conducting this lecture series for corporate reporting, myself and Sukun. Sukun will be done by some of the standards. I think that the calculation was given. Yeah. Previously, actually, full syllabus was conducted by myself, but with this arrangement, with the time limitation, I took some part. It's doing some part, but you are free to ask any question about any area, right? Maybe biological asset, maybe some other standards. I will teach you how we are going to learn it, right? Okay. Cool. We'll start from a case you learn. Yeah. Case 33. EPS. Chat. We are having 3 parts in this subject, right? First one, standard. Second one, console. Third one,
hello, sir.
financial. Yes. Here we have right?
Oh, yes, sir. We cannot see anything, sir, that what you are writing over there.
Oh, yeah, I'm helpless. So I supposed to use whiteboard full time because we have to do calculations, consolidation. This whiteboard may be not enough. I'm using the board this board as well. Once we are doing consolidation, right? Once we are making consolidation, we want another board. So how we can manage it then? Huh? Smart board? Smart board and share the screen. Is it? Okay. But it is not that. Yeah, you can do that. But doing console question here may be not that easy. Right? Then the last row first may not be seen this. How can we be console here? We difficult, but today we can manage it. Last time? Excel. Excel knowledge. You see this screen now?
Not yet, sir, not yet.
Yeah. Right. Again, in the whiteboard, I will try to move on to this board. And in first also we are planning to do some calculations, many calculations. So want to do this, otherwise it will be that's not clear to you all. We'll see. I talk to Seth, they will arrange something. We'll see here that will continue through the board. Yeah. As I said, here we are discussing about 3 areas, right? Basic standards, and then consolidation, and financial statement analysis. These are the 3 subject areas you need to focus. Once we are conducting lectures, you need to know where we are, right? Standards, we have several standards here. Consolidation, very important area. Console we are planning to do, not just consolidation, right? Consolidation, we are having different topics. Okay, we are having acquisitions, disposals, step acquisitions, step disposals, foreign subsidiaries, subsidiaries. I'm not planning to do subsidiaries, but we'll see in the time limitation. These are the things we are going to focus. And the financial reporting we learned about basic consolidation, right? How we are going to acquire a company. Here we are going to discuss step acquisition. We are acquiring a company step by step. Maybe associate convert to a subsidiary, right? And sometimes you are having 75% ownership, you are changing to the 85%. 85% turning to 100%. That's called step acquisition. That will be done by consolidation, right? And then step disposal like that. We are disposing a company step by step. We had 100%. We are disposing 10%. And then again 15%, again 30%, likewise. We are disposing, right? Now we are going to treat that under consolidation. And then foreign subsidiary. Now we are going to convert foreign subsidiary to local consolidation. That will be done by under this topic. That will be the complicated area under this corporate reporting subject, right? But here this part will be very straightforward. So that is the last actions under financial reporting. You know that financial accounting, we had a definition. So these details about transaction, gathering, summarization, and analyzing all these results and then interpreting and communication financial results to stakeholders. That will be done under financial statement analysis. Under financial statement analysis, we are discussing different methods like ratio analysis, common size financial statement analysis, trend analysis, maybe some other techniques. So this will be done by sometimes Sukun will be done by this area. I'm focusing about console and some of the complicated standard under here. Whatever the standards allocated to this corporate reporting are not common standards. Some rare standards like government grants, agriculture, segmental reporting, foreign currency. Likewise, we are having bit complicated standards. Right? So under that, we are having this earning per share. So one of the standard. Today we are going to complete, right? And I'm planning to do some questions, calculations. So this is a highly focused area for the exam. Definitely you can earn 15 marks in the exam. We have a compulsory question under earning per share. That's why we are learning. After completing earning per share, you should have a proper understanding about earning per share, why we are learning it, what's the requirement, and everything you should know. That's why we are learning. Each and every student, not one student, not the people are in the front row. All the students should be aware about this. Don't wait till the last moment to learn. Don't wait till your friend making your book free or something like that. So get maximum out of the lecture room, right? Okay. Right. We'll jump into the standard and anything you know about this standard. Very special standard. Why? Earning per share is a financial ratio. Here we have ratio analysis, right? Ratio analysis. Under ratio analysis, we are having different ratios. Right? Liquidity ratios, maybe efficiency, operation, different ratios are there. Market related PE ratio, earning per share, dividend per share, different ratios are there, right? Once you are calculating ratios, once you are doing it, we don't have any, given guidelines, rules and standards for all other ratios. Out of these many ratios, the regulated, can't say that regulated, standardized ratio is earning per share. We don't have a standard for gross margin. We don't have a standard for stock turnover ratio, current ratio, liquidity ratio, not liquidity, quick ratio. We don't have a standard, right? But earning per share, we are having a standard. Why? First, why we are having standards here? The basic question, right? It is not a question to ask from you all, right? Why we are having standards here? We are having LKS and FRS. Right. These are only standards we are governing through the standards, right? I'm discussing here why. And before that, why we are having this standards? Accuracy. To enhance the accuracy. We should have a standard, no? Yes. Correct answer. Anything else? To enhance the comparability. Very good. Comparability. So if you don't have any rules or regulation, we can't compare. people are doing counting for their betterment, not for stakeholders' perspective. They are doing by using different techniques, different procedures. They are following different methods, and they are getting different outcomes. Not only that entity, for several years, they are using several practices. If it is so, they can't compare at least their financial years. They are 2025 can't be compared with 2026. If it is so useless of making financial statement, then there we came up with standards, LKS and SLFR. Why we are having two sets here? LKS and SLFRs. Any idea? දන්නවද කියන්නේ නැහැ. ඇයි මේ මාර්ග දෙකක් තියෙනවා? Financial reporting framework. SLS, LKS, SLFRS, SIC කියලා දෙනවනේ. SIC කියන එක නෙවෙයි. SIC. IFRIC, SIC, so there are financial reporting framework. Saya join in the lama hen ne. Bye. I think now they can hear us, right? Can you hear us?
Yes, we can hear. Only problem is that we cannot see what you are writing over there.
So today actually we are not writing that much. Once we are writing important things, definitely we'll arrange the screen for you all. I just writing some small stuff in the whiteboard here. Don't worry about that. But I supposed to do some difficult calculation today under earning per share. So that time definitely you need to focus on the whiteboard. But be patient. We'll share whatever the content we are teaching here. So I talk to SAP. They will come and arrange this smart whiteboard. Then I can share to your screen. We'll do that. Till that, we are discussing some basic stuff here. I'm asking question, why we are having this LKS and SLFRs? ඇයි ඒ වගේ දෙකක් තියෙන්නේ? දන්නවද? ඇයි එහෙම මාර්ග දෙකක් තියෙන්නේ? දන්නවද? ඒ දෙකම එකයි වගේ. තව ඉස්සරහට LKS එන්නේ. We are having SLFRS, right? Now we are dealing with SLFRS 17, 18 supposed to come, 17 also planning to implement, right? 17 about what? Insurance contracts, right? That's a very difficult standard. Maybe the Okay, so you all can see now the screen. So I will use this.
Yes, sir.
I will
Can
use
see.
this.
Thank you, sir.
Okay, so if we can't manage here, so we'll shift to there. So we'll try to maximum manage here. Right. So we are having this LKS and SLFRS. LKS, we are not having any further versions. We stop with LKS 41, right? You are learning agriculture. That's the last standard we got under LKS, right? So going forward, we are having SLFRS. So this SLFRS 18 supposed to come. SLFRS 17 we are planning to implement very recently, maybe 2026, right? That's about insurance contract. We adopted SLFRS 16. What is that? Lease. That's all about right of use asset, right? SLFRS 15, revenue, right? Revenue from contract with customers. Likewise, we are getting SLFRS now. That is adopted through IFRS. This is a change came through the committee change. Previously, we had standard interpretation committee globally, right? It's changed to standard, the International Standard Monitoring Board, right? With this change, their guidelines got changed. Right? So after finishing the tenure, the period of standard committee, they whatever the guideline issued by that committee we call as IAS, otherwise LKS. So after turning into standard reporting board, they are issuing SLF in IFRS that will convert to SLFRS, right? So that's general knowledge you should have, right? Then I'm talking why we are having these standards and whatever the complicated areas, standard setters issuing these guidelines, right? Then what do you mean by this SIG and IFRIC? SIG and IFRIC. SIG, there's no further SIG. Standard Interpretation Committee. We are having IFRIC. IFRIC. Going forward, we are having IFRIC. IFRIC means once we are issuing a standard, sometimes they can't complete. Complete means they are not covering each and every implication. Once we are implementing it, at the point of implication, they will have some argument. Some areas may not be covered through that standard. If it is so, can we amend the standard and reissue type of a version? No, we are not doing it. We are issuing an interpretation. right? We had LKS 38. What is that? 38. Intangible assets, right? Intangible assets. After implementing intangible asset, we didn't have a guideline under here. What is that? The internally, once I developing a website, how we can capitalize it and how we can manage it. So once they are developing a website, the accountants and the industry, they wanted to have a clear guideline. So the LKS 38 doesn't provide a clear guideline about the website development. For that, they issue what? 632. 632. That's clearly interpret if you are developing a website, how we are going to capitalize it. That's the interpretation for the case 38. Likewise, once you are having a standard, if some areas not going to cover it, the standard setters will issue some interpretation. Those are the small guidelines given by the standard setters, right? That's called imprint. Going forward, we are getting imprint. This is also the change of that committee. The six came to standard interpretation committee. This comes from standard international standard monetary board. I don't know whether we are having monitoring standard international financial reporting standard board, right? IASB. Yes. Their interpretation we call as imprint. Keep remember that now the surrounding and the background. And now we are moving to 33. Now we know what is LKS, right? We are moving to 33. 33 about earning per share. Earning per share is one of a ratio. This is the first time we are having a standard for ratio. Why? It's a sensitive and very useful ratio we are using for decision making. Because of that, standard setters want to give proper guideline how we are doing it at different situations, how we are managing this, how we are going to calculate this. Because people, the accountants, they used to calculate this by using different methods for their betterment. For they want to show their colors, they want to show their performance, to show that they wanted to use that in different ways. If they want to have more, they want to have type of a good picture about the organization, they are increasing the earning per share by using, not using the performance, but using the calculation. Then manipulation of earning per share, that will impact to shareholders' decision. Why? It is a very sensitive ratio. Sensitive ratio for what? For investors. Once you are investing in a listed shares, listed market, the earning per share is a very critical ratio. You are looking at the company about their performance. Once you are investing a share, you should have an earning, right? Once you are investing a share, what are the two expectations you are having? You are expecting dividend, you are expecting capital gain, right? So before you are investing, you should have a different perspective. Different perspective. You are investing to earn dividend or earn capital gain. Sometimes you are investing to get the control over their investment, right? Different perspectives are there, but once you are taking a decision about a company, earning per share is one of a very critical number, ratio you are looking at. That's why we are having a proper guideline. Otherwise, A company earning per share can't be compared with B company earning per share, right? EPS, A company to B company to C company. If you want to compare that, Definitely we should have a guideline. Otherwise, they will prepare based on their perspective. Example, gross margin. Differ, right? You know how we are going to calculate gross margin. Gross profit divided by sales, right? We know that, but they are manipulating it. If you are comparing two hotels, can you compare that? Very difficult. Why? The way you are calculating gross margin is different. Some hotels, they assume that depreciation of the building as cost of sales. Is that meaningful? Yeah, they are logically explaining that why. As a hotel, the building is a machine to them. Machine depreciation is a cost of sales. Right? The building they interpret as a machine to the hotel. Fair enough, right? Other than admin areas, other than the bank office and the finance division and HR division, whatever the hotel rooms, that is a machine for them. It's fair to transfer to the cost of sales. They are charging to cost of sales. Some hotels, they are charging to admin expense. If it is so, your gross margin, the calculation, there's no guideline. Because of that, the comparison always be very complicated. Comparison can't be done. Because of that, we are having proper guideline for earning per share. Right? That's the basic understanding you should have. Right. Under earning per share, I'm going to discuss these topics. Yeah. Basic EPS. Second. These are the four topics. Four topics. 5 topics. 5 topics we are going to cover today. Basic earning per share, bonus issue, BI, earning per share, right issue, earning per share, diluted earning per share, and related disclosures. Right? These are the 5 areas we are going to cover. First, we are going to learn about basic earning per share. How we are going to calculate basic earning per share. I want any notes for this? No need, right? Notes on? Not clear. අපන්න කට්ටිය ඉල්ලනවා notes එතකොට note දෙනවා දිගටම ලියා ගන්න. Also married. Right. So here, basic earning per share, first topic. We are going to calculate it. Basic earning per share. Earning per share, very simple, right? Earning per share. Earning divided by number of shares. Simple, right? No need to learn, but here we have a standard. Then and there will be a complication. That's why we are using a standard, right? But from the topic we can make it very simply. Earnings divided by number of shares, right? And we can say that not number of shares, EPS equal earnings. Earnings divided by weighted average number of shares. Weighted average number of shares. Earnings divided by weighted average number of shares. Earnings, we can say that profit after tax. Profit after tax minus dividends. Any preference share dividends or something like that. Preference share dividends. Profit after tax minus preference share dividends. Basically, this earnings should be taken to the ordinary shareholders. We are calculating earnings per share for ordinary shareholders. Then we are getting number of shares, which shares, ordinary shares. Right. Earnings per share. Weighted average number of shares. Earnings per share equal profit after tax minus preference share dividends divided by weighted average number of shares. What do you mean by this weighted average number of shares? I know you can calculate profit after tax, right? You should know that preference share dividend. Why we are going to deduct here? What's the reason? So preference share dividend. Preference shares normally you are having two parts. Preference shares. You may have preference shares equity type. Equity type. Some preference shares debt nature. Right? If it is equity type, you are paying dividend. If it is debt type, you are paying interest. Right? If it is interest, you have already deducted from profit after tax because interest charge already charged before the tax. You don't need to deduct it. But if you are paying dividend, definitely it has not been charged to P&L. You're supposed to charge it to the equity statement, right? It is outflow which is not delivered to the ordinary shareholders. Definitely we need to remove that from the profit after tax. Are you getting me? I hope it is clear. Okay. Start up there. That our make a complicated way. Preference shares, there may be different preference shares. Cumulative, non-redeemable preference shares. Non-cumulative, irredeemable preference shares. You need to know all these things. Once you are discussing all these things, it will be complicated. You need to know basic equation. What is that? Earning per share equal whatever the relevant profit to ordinary shareholders. Profit relates to ordinary shareholders. Profit relates to ordinary shareholders. Right? Ordinary shareholders. Weighted average number of shares. Weighted average number of shares. This is a bit complicated, you should know. I have the weighted average number of shares. What's the reason for having weighted average number of shares? I'm taking an example here. Right. Let's say you are having January 1st. January 1st, you are having 5,000 shares. 5,000 shares, right? And for the year 2025, your earnings 5 million. 5 million. 5 million. And first day to 31st December. 31st December, you are having same shares. Then your weighted average share also 5,000. You can simply divide it by 5,000 divided by 5 million divided by 5,000. Right? Earning per share, how much? 1,000. Simple. Weighted average number of shares, implication may be changed at the point of a share issue in between the financial period. Within the financial period, if there's a new share issue, then your number of shares should be weighted. Let's say the same example, 2026, this year, the opening shares again 5,000. Again 5,000. They issued new 1,000 shares. 1,000 shares. 1st April. 1,000 shares they issued. Then, once you are completing, you are getting an exam paper, including this question, then your financial period may be ended. 31st December 2026. Once you are calculating earning per share, your number of shares how much? If you don't have any further share issues during the year, your number of shares 6,000. 6,000, right? Then this year profit 6 million. Let's say 6 million. 6 million. The 6 million divided by 6,000. You can't do this. Fine. You can't do this. You can't use this 6,000. That is the reason. You need to think about why. That's why we are having weighted average number of shares and certificates. We need to give that weightage for the period. Why? We are using two elements for ratio, right? We are using this one P&L item. 6 million P&L item for the period concept. But this one asset concept. Asset concept. Right? So we are dividing for the period concept by using asset concept. Then what we need to do? We need to give a weightage. The way we keep within the period, the contribution which was given to this profit. Okay. To generate this profit, this 6,000 shares contributed, right? This 6,000 shares contributed to generate this profit. But out of this 6,000 shares, 5,000 shares contributed 12 months. Okay. Another 1,000 shares contributed not 12 months, only 9 months. Right? Then once you are calculating earning per share, divided by 6,000, not fair enough, right? Not fair enough. You need to give a weightage to that time. Okay. Wow. Lectures. Maybe the 8:30 lecture, you are coming 10:30. You are passing all the transportation methods. Bus train. So getting late, what you have decided, you are getting a boarding place nearby set. After that, you are coming to the staff. Maybe 6:30, 7:30, you are coming and open the doors and you are ready in the classroom for the lecture. So your friend asking from you, previously you came late, now you are coming much as early, you are coming to the lecture. So here now, I'm a boarding place. Here. Then your friend also want to do the same. Your friend also, person getting late, is accompanying with you to stay in your boarding place. For your boarding place, you are paying how much? For the year, 100,000. For the year, 100,000. Right? You started from January, ending from 31st December. දැන් ඕක දැකලා යාළුවා ඉන්නේ කවදින්ද? යාළුවා ඉන්නේ කවදින්ද? 30th June ඉඳන් එන්නේ වගේ යාළුවා. Right? So you supposed to pay the rent. It's a very fair, very reasonable landlord. They have agreed to pay the rent at the last day. After completing the Nihamasamanya campaign, we need to pay key money and we need to make advance. But for the example, we are taking this. At the last date, we are supposed to pay 100,000. Then payment take 100,000 boarding first 6 months or 6 months. Now the final day, the landlord asking rent. It is 100,000. Why now we are having 2 people in the body. Shall we divide this 100,000 by 2? Pay 50,000. You can pay 50,000. I will pay 50,000. Can you agree with this arrangement? Make a pay Can you agree with that arrangement? යාළුවා ඔයා අන්දන්න හදනවා නම් අන්දිනවද? ඉච්චර අඳින්න එපා ඇත්තට. යාළුවාව අන්දන්න හැදුවට 50-50 බෙදාගමු කියලා. ඔයා ඉච්චර මොඩ වෙන්න එපා. නේද? ඔයා මොකද කරන්න ඕන? නෑ. So first 6 months you were there alone, right? Then first divide. First 50,000 you have to pay. The second 50,000, half I will pay. That's the way. Then what we have done here? you have given the weightage for the period, weightage for the contribution, right? Likewise, what we have to do here? What we have to do here? We need to give a weightage for the time period. That's why we are having weighted average number of shares, right? So then, take a question here. ABC company, write it. ABC company. ABC company has issued 10,000 ordinary shares. 10,000 ordinary shares. 10,000 ordinary shares. For the capital requirement, the management of ABC decided to issue another 5,000 shares, as of 1st July 2025. 1st July 2025. For the period ended 2025, ABC earned 12.5 million profit after tax. 12.5 million profit after tax. The CFO, Mr. Pereira, seeks your advice to calculate. The CFO, Mr. Pereira, seeks your advice to calculate earning per share for the period 2025. Earning per share for the period 2025. Station number 1 done. You can go to LMS and I have uploaded the question bank, right, about the share. You can get that and try for question number 1. Question number one. Question number one. Profit after tax for the year 31st December 2021 was 7.2 million. Number of shares was Jan 2021, 800,000. Another 600,000 shares were issued 1st July 2021. Redeemable preference shares 300,000. Non-redeemable non-cumulative preference shares 200,000 for per dividend, right? Calculate EPS for the year 31st December 2021, right? So here we have different types of preference shares. Different types of preference shares. What are the types? Redeemable, non-cumulative. Cumulative, non-cumulative, redeemable or irredeemable. You need to understand what it is, right? By nature, by looking at that nature, you can decide whether we are paying interest or dividend. Right? You can see redeemable preference shares 300,000. Redeemable means those preference shares will be redeemed. Redeem means we can pay cash and we can remove it. Redeemable means fix a date to redeem it. Redeem means it's like payment of a loan. We can prepay that preference share capital. We have a fixed date and fixed interest as well. Right? Redeemable. Redeemable means it's obviously we are paying interest. Right? And then the second one, what is that? Non-redeemable, non-cumulative. Non-redeemable means there's no date to redeem it. It means very similar to very, not totally equal to ordinary shares, very similar to ordinary shares. There's no date to redeem and non-cumulative. Non-cumulative means whatever the agreed interest. If you are not paying this year, it is not getting cumulative for next year. If you are not paying this year, maybe interest, it's not going to accumulate for next year. There's no interest payable. Let's say this year loss making year. Loss making year, we are not paying any remuneration or some type of interest to them. 10% interest agreed, but this year we are not paying. It won't be accumulated for next year. There's no dividend payable. What do you feel then? That shareholder like a ordinary shareholder, no? Very similar to ordinary shareholder. Ordinary shareholders, if there's no profit, they are not getting any dividend. Similar to that nature, we are having set of shareholders. We have issued preference shares. They don't have voting right, but we don't have any period to redeem. It is not accumulating. Then they are very similar to ordinary shares. Because of that, we are paying dividend. Then we are not getting that cash outflow for the P&L. Under financial cost, we are not putting dividend payment for preference shareholders. We are parking it where? Equity statement. Equity statement is the. Then once we are calculating profit after tax is 7.2 million. 7.2 million. We have not deducted that dividend. Right? Then what you have to do? Deduct that dividend and calculate the profit after tax relates to ordinary shareholders. Right? Ordinary shareholders. It is correct. Irredeemable, we need to deduct. Why? We need to get this. Equation, earning per share equation. We are dividing. Only we are getting for this ordinary shares. We need to get the profit related to ordinary shareholders, right? Ordinary shareholders. Once we are having this irredeemable or non-cumulative, irredeemable. Non-cumulative means that profit won't be cumulatively, meaning we are not supposed to pay. If it is a loan, we are not paying this year. We need to pay that loan amount next year, right? So those are type of liability to the organization. Because of that, we are not paying any dividend for them. But this type of shareholders, they are very similar to ordinary shareholders. Because of that, we are paying dividend. Then we are not deducting it under P&L. P&L finance cost. We are not putting. We are putting redeemable preference share interest. We are putting under financial, but we are not putting irredeemable accumulative dividend under here. We are putting it where? Under equity statement. Equity statement. Under equity statement, we are putting profit after tax. Under that, ordinary share dividend, preference share dividend. Then it is a cash outflow. It is not transferred to ordinary shareholders. Because of that, we are going to deduct. Right? Then deduct it and calculate the. We have a weightage here, right? Weightage. What's the equation then? the equation.
So you use that
I hope this is clear. This 300,000 into 2, we are not getting for the calculation. If you remember that. 300,000 into 2. Question was given, right? 300,000 and 2. Put a asterisk and say this one not going to deduct from profit after tax because it is already been deducted. Because it is type of a loan to the organization, right? Right.
So the idea is if it's similar to the share, we do that.
Yes.
And cumulative also reduce.
Cumulative and non-redeemable are going to reduce because we have not been already deducted from the P&L. Whatever the loan type, borrowing type things, already taken to the P&L as a deduction of the finance cost. This 300 into 2, you can see, right? Already deducted. Why? It's a loan. Once you are calculating 2.7.2, already deducted it. Now you need to deduct it again, right? Okay. Very good. Can do. I will upload these things before the lecture, and then I will give answers as well. Don't worry. I hope it is clear about basic earning per share. dealing with different dates, dealing with different instruments, right? Once you are going to the exam, there may be some deviations. Now I think you are comfortable with the concept. We'll do some exam questions later after doing all these stuff, right? So now we are going to another concept. What is that? The second thing we discussed. Earning per share adder, bonus issue. Earning per share adder, bonus issue. EPS adder. Bonus issue. Bonus issue. Bonus issue means share issues can be done in different mode. Bonus issue, right issue, normal issue, IPO, different share issues were there in a company. Right? Bonus issue is a reward to the existing shareholders. Existing shareholders, but it is not a cash inflow to the organization. That's the uniqueness of this bonus issue. With compared to the normal share issue or right issue or bonus issue, we don't have a cash inflow. Cash. Whiteboard is very slow. Slow as it's like blue slide. Cash inflow. No cash inflow. Right? Once you are issuing shares, normally it's supposed to receive cash, right? But the double entry, cash, debit, credit to stated capital. Right? Once you are issuing bonus shares, we are giving shares to stakeholders. Stakeholders mean available shareholders. We are not receiving cash. So we are giving shares mean share capital credit. We are going to debit. We are not getting cash. We are not going to debit cash. We are supposed to debit where we need to debit it to retained earnings. Retained earnings or some other reserves. Bonus issues we are issuing through retained earnings, right? It's like capitalization of retained earnings. If we are having more retained earnings, we can give these retained earnings to available shareholders. Normally, we are doing this activity. We want to go for a new share issue, right? New share issue. Before that, we are doing some bonus issues. Right? Once you are issuing new shares, once you are having all new shareholders, they will supposed to ask about our return earnings, right? So return earnings actually that's the return earnings contributed by the existing shareholders. So all whatever the return earnings having in the company, those were created, generated by the existing shareholders. Then those return earnings are supposed to pay to our shareholders, available shareholders. Because of that, it is a type of a capitalization mechanism in organization. Convert return earnings to normal shares. What we are going to do, we are issuing a number of shares without having any cash inflow. At that point, what we are going to do? You can understand that there's no any additional contribution in between. Let's say the complication may be coming mid of the year if you are issuing the bonus issue. You are issuing bonus shares at the mid of the year, question is, do we need to still giving a weightage? Right? Weightage should be given if we are having different contribution. Already that contribution was there in the organization. If it is so, we don't need to make any weightage. We are not giving any weightage for bonus issue. If you remember that. How are we going to do that? Let's say you are having you are having 5,000 shares at the initial date. You issued one share for each 5 shares. One bonus share for each 5 shares at 1st July 2025. Then 12/31st, we are having how much of shares? 6,000 shares. 6,000 shares. We had 5,000 shares. We make a bonus issue of 1,000 shares. 1,000 shares, in other words, we issued 1 share per each 5 shares. Now we calculated 5,000 divided by 5,000. We issued bonus shares, right? All together, end of the day, we are having 6,000 shares, right? So examiner will ask from you to calculate earning per share, right? At this scenario, question is, this 1,000 shares came into the picture from 1st July 2006 onwards. Question is, still are we need to do this weightage? Answer is no. Why? This 6,000 number increased, but the contribution was there from 1st day onwards. There's no any cash inflow to the organization. If it is so, these shares were there from this day. Not only that, we need to restate last year and change the earning per share. We calculate 2024 earning per share. If you have done a bonus issue this year, go back and restate last year. Why? Last year, the 1st date of the last year also we had this 6,000 shares. Something like that. Then the answer is, if you are having bonus issue, don't give any weightage. Consider that bonus issue was done 1st date of the year. Right? Put a note. Once you are issuing bonus shares in organization, there's no extra cash inflow. There's no extra cash inflow. There's no extra cash inflows. It is just a capitalization of retained earnings. It is just a capitalization of retained earnings. It is just a capitalization of retained earnings. Since it is not required to, calculate weighted average number of shares for bonus issue. Example, question number question number 3. Can you do quickly? Question number 3. So here we are discussing about one theory part. Earning per share is not a mandatory disclosure for private limited companies. Right? It is a listed company. It's a listed company. It is a mandatory disclosure. If you are doing accounting for private limited company, it is not a mandatory disclosure. Remember that. And then, if you are doing consolidated financial statement, we need to give earning per share for consolidated numbers, not for individual parent numbers. Calculate that right. I hope it is clear about bonus issue. Okay, once you are having a bonus issue, don't want to make a weightage, right? But here I'm highlighting one thing, very critical thing, additional thing. Once you are dealing with earning per share, it is mandated to do for listed entities, right? And consolidated figures. This option to give earning per share for private limited companies and individual companies. If you are giving consolidated financial statement, you're supposed to give earning per share for consolidated figures, right? Now we are going to discuss about earning per share and a right issue. Earning per share and a right issue. Learning to share and write this. Third question. Okay. Can. Yeah, third question. Answer. So here, profit was 4.8 million. EPS. After that, I hope it is clear. This one, they asked you had first day. This is okay. These are the two things you have in communication. We have given 400 shares, they have collected 50%, right? Uncollected, unopened shares, we are not getting into the books. Only 200,000. Right? Only 200,000, we have given the weightage. When we issued that, April 1st, right? April 1st means 9 divided by 12 for the period. And what is this? Bonus? Bonus issue, right? Bonus issue for the 12 months. Otherwise, you think that bonus issue was done November month. We are giving a weightage 1 divided by 12. There's no weightage for this bonus issue. That's the only thing you are learning here. Okay? Okay. Bonus issue, we are not giving any weightage. Right. We are coming to here. Earnings per share and right issue. Put a note. Right issue is a option. Right issue is an option. The management can use. The management can use for their financing. For their financing. By using a right issue, company give more priority. Company can give more priority for the existing shareholders. Company can give more priority to the existing shareholders by issuing discounted shares to the existing shareholders. Whatever you can write, what we are going to do here, management can raise capital through using this. What we are going to do here, we are issuing discounted shares to existing shareholders. Discounted share means our share price may be 30 in the market. We are issuing shares for 20 to existing shareholders, not to the market, right? Right issue means to accept those shares, we should have a right. We are giving a right to existing shareholders, right? Okay. So once you are having this right issue, this is the area more complicated once you are doing earning per share. Okay. You know, once you are having this share issue in organization, as a shareholder, bonus issue, we as a shareholder, they receive free share. Okay. But once you are having a right issue, he is not receiving free shares. He is getting discounted shares. It means he is supposed to pay some cash, and he is getting some privilege, some discount. Then once you are converting this number of shares, whatever the share issue, X number of share issue, you need to split this to two parts. Under this right issue, we have given some free shares to them, free shares to shareholders. That's a discount. And then we have normal shares. Normal shares means we have cash as well as a discount. That discount should be converted to a benefit, overall benefit, right? Then from once you are having a right issue, we need to split that right issue number of shares, maybe 50,000. Under this right issue, what's the bonus element? And what's the normal shares? Bonus element and the normal shares should be split. Let's say we are having 5,000 shares. You can see if we are issuing these 5,000 shares in the market, we can get the real 25 per share. But we are issuing it through 15. 15 means we have given a benefit to existing shareholders. Right? that existing shareholder benefit should be converted to number of how many number of shares we have issued free and how many normal shares. Then and there we can calculate earning share equivalently. This calculation will be a bit complicated, right? For that we are having small step, right? These steps are not there in the standard, but for me, these are the basic steps. Right? First, what we need to do, you need to calculate steps. But the topic is done steps for EPS. EPS at the right issue. First, what we need to do, calculate the PERP, theoretical extract price, right? Calculate the second, calculate adjustment factor. Theoretical exact price. Theoretical exact price. As in. Theoretical exact price for the ERP. Theoretical exact price. Exact price. Extract price is dash RIGST price. Calculate adjustment factor. Adjustment factor. Adjustment factor. Third. Calculate adjustment factor. Third. Calculate bonus element. Calculate bonus element. Calculate bonus shares. Calculate bonus shares. Fifth one. Calculate EPS. Calculate adjustment factor. Calculate bonus element. Then calculate bonus shares. Then we can say that calculate number of bonus shares. We can number of bonus shares. Number of bonus shares. And calculate earnings per share. These are the basic steps we need to follow. Once you are having a bonus issue. So we'll take a quick question. Because we had a break before we are starting the lecture, right? We gave a break. People who want to go for washroom or something like that, or maybe you can go out and come. Right? I will make a question here. Right? Yeah, we'll try. So here we have question. Early share right to question number 5. Question number 5. We need to calculate. First, we need to calculate question number 5. I'm not giving calculate to you. I'm doing with you, right? Question number 5. Calculate here. Calculate here. Market value of existing shares. And then cash receipts, cash consideration receipts. Market value of existing shares plus cash consideration from new shares. Right? Here, ada me formula ni mana tu last na balaga. Ek balaga tu. Eka bina macam mana ni? Market value of the share issued before the right issue. In other words, existed shares mean market value of the shares before the right issue, right? And proceed from the right issue, the cash consideration received from the right issue, and then number of shares before the right issue and number of shares in right issue. දැන් උග වචනේ මතක තියාගන්න. තාම අපි formula එකනේ ලියලා තියෙන්නේ. We need to understand what do you mean by term. Still we don't know that. We just calculate it, right? Okay, I will not calculate it. Here, number of ordinary shares this much, and we should write it this much. Okay, you can see market value of shares 20, right? Yeah, if you get shares for discount, what's the share issue price? 12. Okay, then market value of existing shares, how we are going to calculate? 20 into 5. 100 to 500. 500,000 into 20 plus cash consideration from new shares. How much of shares you are issuing new? 400,000, right? 400,000 into 12 divided by this. Making an answer less than 20 went on. Help always less than market value of the shares. Help always less than market value of shares. The answer always should be like this. What is this? This is the market value of shares 20. What the exam again? Always market value is higher than this answer. Why? We are issuing this shares for 12. New shares are issuing 12. Obviously, it should be less than 20. We are calculating what here? Theoretical exercise price. Mean as at today, if you are getting theoretically the share value of current organization is this, but market value of shares like this. Because of right issue, the market value of shares differs with the theoretical exercise price. How much? $16.44, right? Now you can see this is less than market price. Now we are going to do next step. What is that? Adjustment factor. Next step, the first step, we are going to do the next step. $1.2165. Adjustment factor. Right. Adjustment factor. And we are going to do third step. What is that? Bonus element. Bonus. This is the bonus element. The adjustment factor -1. The bonus element. This is type of a. This is the portion of bonus element inbuilt in the right issue. Right? Because of right issue, we had the market price 20, theoretical extra price, current value of shares in the organization 16.4%. Right? Dividing this market value by using term, we are having answer, adjustment factor. What do you mean by this? In compared to the market, we have given this much of benefit to our existing shareholders. We can call that this is the bonus element. That's why we got deviate this and this. We issued share not to 20, we issued share for 12. Because of that, our share price dropped to 16.44. How much is it dropped? It should be equal to 1. Should be equal to market price. It was deviated for this element. That's called bonus element. We'll study this in depth after doing the calculation. After having the calculation, you have numbers and you can think about. Right. Now just do the calculation. Okay. Right. Now you have bonus element 0.2165. Right. Both. Bonus shares 0.2165, right? 65 into existent shares. 500 shares. So we have given bonus shares to existing shareholders, right? Is the bonus element into existing shares. Equal how much? This one is the bonus shares. Bonus shares. What is the benefit given to existing shareholders? This is the existing shareholders, right? 500,000. What is the benefit we have given? 0.2165 into existing shares. This much of free shares we have given to existing shareholders, right? Not free shares. Per one share we have given 8 rupees. If we convert it to number of shares, this much. That's the meaning. We are coming to that picture, right? Then how many shares we issued? How many shares we issued? 400 shares, right? 400 shares we issued. Minus this. We call as the normal shares in the right issue. Normal shares in the right issue, how much? 400 minus 400 minus bonus issue. This is the normal shares. Normal shares in the right issue. Normal shares in the right issue. Okay, all done. Now we are going to do the earning per share calculation. Earning per share calculation. Here, what we are going to do is the opening shares. What is this? Is the bonus shares. Bonus share. You know that bonus shares what we learned previously? If it is a bonus shares, we consider that as that was their full year. That is the benefit we have given to the existing shareholder as a bonus, right? We converted to bonus. Bonus shares, we have given the full weightage. For the normal shares, what we did, we have given the weightage. Right? What we have done here, whatever the new shares issued, with the 400 right issue. What we did here, 400 right issue, we divided into two parts. What's the bonus element? What's the normal shares? Bonus element, consider for full year. Normal shares, we have given the weightage. Right? Right. I hope this is clear. You can, by using these steps, follow these steps, and you can try question number 6 at home, right? Question number 6 you can try at home. Now I'm planning to discuss diluted earnings per share. Last one. Diluted earnings per share. It is a kind of a, not this much complicated, it's a concept. It's diluted earnings per share. Anyone who can't understand this, let me know now. This is the area will be tested in the exam. This preferential and all. Yes. That part is not clear.
This is all.
Okay. So this preference shares and this and that basically is a matter of the way we are calculating P&L, right? P&L, you know, right? We are having the trial balance, and by using the trial balance, we are calculating the trade account, and then profit and loss account. Once you are calculating profit and loss account, we have different expenses, right? After finishing trial balance, the trade account means trade account can cut. What do you mean by trade account? Trade accounts means the summary of the inventory account. Inventory is asset, it's a different asset, right? Inventory is asset, we don't have a continuous account. Other asset, we are having a account, we are keeping all the record in same account. As in cash account, opening balance, cash receipt payments, so end balance, right? PP&E, opening balance, addition, disposal, end balance. We are keeping a account, opening balance for transaction, we can calculate end balance. But inventory is a different account. You know, right? Inventory is a different account. We are not keeping continuously. We are not recording entries continuously. Whatever the impacts for the inventory account, we are keeping in different accounts in organization. Different accounts. Opening inventory, keeping aside. Purchases, different account. Return, different account. Sales, different account. Sales return, different account. Because of that, we can't come up with the end balance. Right? Then and there, what we have to do? Then and there, each and every trial balance, under the trial balance, there should be a closing inventory balance. Why? We can't calculate closing inventory through one account. They can have a TP year-end stock. Is this still there? That's the reason. In organization also, there should be stock count. We don't want to have a cash count in each and every organization. Why? We can tally the cash book. But each and every organization should have a stock count. Why? Year-end stock we can't get through one account. All these entries will be recorded in different accounts. Opening stock, we are not putting any entry. Hey, very opening inventory, purchases debit, credit sales, return debit, sales return debit, purchase return credit. Why can't we get the end balance through one account? No need to do stock count. Why we can't get that answer in one account? What's the reason? We are using two different prices. Purchasing, opening inventory, different price. Selling by adding the margin. If we are putting all this in one account, we are not getting a correct picture, right? For that, the summary will be done through trade account. Trade account will be the gross margin calculator. It's another summary of inventory account. Right. Through that, we are calculating gross margin. Gross margin and deducting all expenses, adding other income, we are ending in profit after tax. Profit before tax, deducting tax, we are ending with profit after tax. Right? Profit after tax, we should know what are the things we have deducted. Under P&L, we are having finance cost. Finance cost. Under that, we are having different payments. We are incurring for loans, borrowing, preference shares, everything. Right? But we are not deducting dividend. Dividend is item we are not putting as an expense in the organization. Right? But preference shares having dual mode. Dual mode means sometimes it is equity type, sometimes it is debt type. Right? You can understand the nature of that. Very close. You feel like you, right? You are a side pocket to left pocket. You feel like your friend's pocket is also your pocket. If it is so, you are not creating a left. You are getting me right? Then those preference shareholders we feel as ordinary shareholders. Then we are not putting the payment what they are doing. We are not putting as a finance expense, right? We are putting that as a dividend. Then we are not getting to the P&L. We are putting to equity statement. Then once we are coming to earning per share is standard very clear. Why? Before we are having this standard, people did different treatment. They consider all these preference shareholders as dividend holders, put to the equity statement. They didn't consider for this earning per share calculation. Sometimes some people are getting considered, some are not. But standard clearly said that you need to get whatever the relevant income for ordinary shareholders. If it is so, if you have not done any adjustment, profit after tax. After profit after tax, we have deducted that from the equity statement. If it is so, please remove that from profit after tax because we are calculating earnings per share. So, before you are ending the earnings per share answer, you have to have an adjustment to do for the profit after tax. In between profit after tax to total earnings to shareholders, there's another cash outflow. What is that? Dividend we paid to dividend type, this ordinary share type to the shareholders. We need to deduct it. And then and there we are arriving to net earnings relating to equity holders. Equity holders mean ordinary shareholders. Then divide that based on the number of shares. Then number of shares should be considered by using the weightage. Once you are doing the weightage, bonus shares don't consider. Consider that from first day onwards. If you are having a right issue, split it to this two. Right? Hope it is clear. And diluted earnings per share. If there's a dilution, we need to disclose. Dilution means possible decrease, possible impact to the earnings per share. That should be predicted and calculated today. And that should be disclosed today. Otherwise, it will be impacted to stakeholders. So this is the last point I am highlighting today, right? We are showing that earnings per share today. Here maybe, let's say earnings per share 10. Earnings per share 10. Simple. Once we are investing in our organization per share, we can earn 10 per year. Right? 10 per year. Maybe you have 1,000 earning. You had 100 shares, right? 100 shares contributed to this 1,000. This is the expectation now. Once we are having the investor, he will come and see. Yes, if we are going to invest this company, we can earn 10 rupees per one share per year. That's understanding. So that with that understanding, they will invest. They are thinking that if we are investing 100 rupees, we can recover that within 10 years. Right? After having this understanding, they are investing here. They are investing, and after maybe 2 years, they can understand that some of the shareholders under this 100, they can convert these shares to double. They can convert their shares to double. There's an agreement with the organization. Within another 2 years, our number of shares will be double. Can you agree with them? How about the new shareholders? For new shareholders, there's no such agreement. So after 3 years, once you are calculating earnings per share, how about the earnings per share? This 200 shares double, now 200 shares. New shares 50. 250 shares. Once you are dividing this profit for 250 shares, that existed shareholders having 2 portions. Are you getting what I'm telling you? No. American ඉක්වේක ගන්න කලින් මැනි කරනවා පස්සේ හරි. ඔයා හොයාගන්නවා one child family කියන්නේ only child spouse කියන්නේ boy කියන්නේ හරි girl නේ. Right. Only child කියලා marry කරනවා. එතකොට ඔයා මොකද expect කරන්නේ? The person who are reading for applied accounting, all the decisions you are taking based on the profitability. Right? You are calculating the net present value and enter into the decision. Parents having 2 vehicles and with some business engagements and number of shares investment, and so some lands are there. All values may be 2.5 billion. To calculate it and so match with your assets. That's a good bill to the decision and marriage. Right? After 3 years, she or he telling I have another brother. මට තව මල්ලි කෙනෙක් ඉන්නවා කියලා. එයා අර decision එකේදී ඉඳලා නැහැ. දැන් මොකද වෙන්නේ? 2.5 billion දෙකට බෙදන්න. How about you? You feel bad, no? You are not that comfortable. At the point of decision, you don't know that we have some other stakeholders. So before you are entering to that agreement, you need to get clear that is there any other stakeholders have invested for this? You need to get clear. Is there any commitment? එතකොට කියනවා නෑ. මේ brother අපේ parents ලගෙම නෙවෙයි. හැබැයි අපේ ගෙදර හිටියේ. ඒක නිසා we need to split some extent. Then you feel bad, right? Then that there you calculate again that 10% value. You are ending with negative net present value. You are supposed to divorce. Right? For that there's a option in this case 33 that is called diluted earnings per share. That means once you are calculating your earnings per share, you use your number of shares. Once you are using your number of shares, if there are any other share commitments today, add that and calculate again your shareholders, EPS. Today, number of shares 100. Within another 5 years, 10 years time, this will be expanded maybe to 200 with the today commitments. There may be share warrants. There may be convertible debentures today. Convertible debentures mean today debentures, it will be converted to shares within another 2 years. So the other is a liability. Within another 2 years, they are stakeholders. Right? Other because rent එකට ඉන්නේ නේද? Rent එකට ඉඳලා ඔයා marry කරනවා landlord ගේ දුවව. Then there's no rent for you. ඊට පස්සේ අවුරුදු දෙකක ඉඳලා ඔයා තමයි boarding එක rent එකට දෙනවා. The shareholder of that. If it is so, earnings per share standard very clear. We have option called diluted earnings per share. It is a safety to stakeholders. They can take decisions about the earnings per share. They can focus about the diluted earnings per share. At the point of decision making, they are clear about the commitment. That's why we have new diluted earnings per share. I just give a heads up today. But I will make some questions about diluted earnings per share next day, right? So today we discuss earnings per share at a right issue, bonus issue, basic earnings per share, and diluted earnings per share. All things covered. And next day we'll do some calculation about diluted earnings per share and disclosure plus past recognition, right? We have to do past recognitions. We'll practice.
Okay.